Hello, my name is Randy Hardock. I've been working with NAPEO on a wide range of tax issues for almost 20 years. Before that, I was tax counsel at the Treasury Department and at the U.S. Senate Finance Committee. Over the years, I've seen a lot of changes that benefited the small businesses that work with PEOs. But today's topic, the Employee Retention Tax Credit, or ERTC, is clearly one of the most important. The ERTC, along with the Paycheck Protection Program, the PPP, are the two key tools Congress has provided for the businesses that have been hit the hardest by the pandemic. Every business that has suffered during the ongoing COVID-19 crisis needs to evaluate how these programs can help them. As you will discover as we go through this topic today, the ERTC is complicated. Whether and how much a business gets depends on the business's unique situation, and determining eligibility and calculating the amount of the credit will vary from year to year and quarter to quarter. But in the end, the ERTC gives eligible employers a very generous tax credit for keeping employees on the payroll. And because it is a refundable tax credit against payroll tax, it is possible for employers to access the money more quickly than a typical income tax credit for businesses. So let's jump into the slides. So the ERTC is there to assist eligible employers in paying qualified wages. Today, I'm going to cover a number of topics: the basic ERTC rules, which employers are eligible, how an eligible employer calculates qualified wages for purposes of determining the ERTC, how the ERTC interacts with the PPP and with other tax credits, and how to claim the ERTC. By way of background, the ERTC was first enacted in the March 2020 CARES Act. It was technically made available to employers of any size, but was of no benefit to many small businesses because it prohibited a business that received a PPP loan from claiming the ERTC. As most of you probably already know, that is no longer the case. Under the December 2020 Consolidated Appropriations Act, the CAA, you can now get both a PPP loan and claim the ERTC, but you can't double count the same wages for both PPP loan forgiveness and claiming the ERTC. Because the CAA made the change retroactive, the ERTC is now potentially available to many more small businesses for wages they paid in 2020, and because they extended the ERTC also for the first two quarters of 2021. And in 2021, it will be easier for a business to qualify for the ERTC, and the credit will be even more generous. But the business will need to meet the rules in effect for 2021, and they are different from the rules that apply in 2020. That means you will have to understand both of the 2020 rules and the new 2021 rules, and we're going to get started on giving you that understanding today. Okay, this is the mandatory small print legalese disclosure, although I've used somewhat bigger print than usual today. Let me summarize. I'm going to walk through the basics today. This is general education. The IRS has not yet provided complete guidance on the recent changes to the ERTC, and certainly not on how they relate to the PPP program. As the rules are developed, you will need to examine them in detail and apply them to your unique facts. In most cases, I believe you'll want to talk to your tax advisors. But since you're watching this video, you're probably also lucky enough to be working with a PEO that can assist you with the ERTC process. In the end, like any other business tax issue, the ultimate responsibility is yours, but your PEO can be an invaluable resource in evaluating how the ERTC can help your business. And once you've determined how much ERTC you are entitled to receive, you will need to work with your PEO to claim the credits. That's because the Congress and the IRS have made the ERTC a tax credit against payroll tax. That means the ERTC has to be claimed through the collection system used for payroll taxes. So let's start with the basics. For 2020, the ERTC gives eligible employers a credit of 50% of qualified wages paid each quarter. That 50% credit applies to qualified wages paid between March 12, 2020 and before January 1, 2021. In other words, if you are an eligible employer and you paid qualified wages in 2020, the government will give you a tax credit that turns into cash that essentially pays half of those wages. One limitation is that for any particular employee, the wages that you can take into account are capped. In 2020, qualified wages are capped at $10,000 for each employee for the entire year. So if you paid your employee Joe $10,000 in qualified wages in the third quarter of 2020, you can claim $5,000 of ERTC for that credit, 50% of $10,000. But you could not claim any additional ERTC with respect to wages you paid Joe in the fourth quarter of 2020, because you already reached the annual 2020 cap for Joe. Still, $5,000 per employee is a pretty good deal. But the ERTC gets even better in the first two quarters of 2021, when the credit percentage is increased to 70% of qualified wages. So the government potentially is going to cover 70% of your qualified wages in Q1 and Q2 of 2021. Also in 2021, the per employee cap rule is improved. During the first two quarters of this year, 2021, you are allowed to count qualified wages paid to an employee of up to $10,000 per quarter. So that is potentially a credit of up to $7,000 per employee for Q1 of 2021 and another $7,000 credit for Q2 of 2021. That's a total potential credit of $14,000 per employee in 2021. Let me emphasize again, this is an employee by employee cap for both 2020 and 2021. It is not determined by counting your number of employees and multiplying by $10,000. You have to look at the wages paid to each individual employee in applying the cap. The ERTC is further restricted by a separate rule that limits the deduction of wages used to claim the credit. A business that relies on wages to claim the ERTC must reduce its ordinary income tax deduction for those wages by the amount of the ERTC claimed. So for example, if you claim the 70% credit in Q1 of 2021 for $10,000 of qualified wages, you are allowed to deduct only the remaining $3,000 of wages on your ordinary income tax return. This is the normal way credits interact with deductions under the tax code, but it is different from the new rule that now applies to PPP loan forgiveness that you may have heard about. The CAA included a special rule that said that wages or other qualifying expenses taken into account for purposes of a PPP loan forgiveness can still be deducted by the employer. That is a very generous rule for the PPP, but it does not apply to the ERTC. We will come back to this later when we discuss the interaction of allocating wages between forgiven PPP loans and calculating the ERTC. Let's learn to how you determine if you are an eligible employer for the ERTC. Your business can become an eligible employer by satisfying either one of two tests. The first way to qualify is if your operations were fully or partially suspended by a COVID-19 government order. So you become an eligible employer for the period your business was suspended either fully or partially, but only during the period of the suspension. The second way to qualify for an entire calendar quarter is if your gross receipts dropped substantially in that calendar quarter when compared to the same quarter in 2019. To satisfy this gross receipts test in 2020, you have to demonstrate a 50% decline in gross receipts for a quarter. In 2020, once you meet the gross receipts test for one quarter, you then remain a qualified employer for the rest of the year, unless your gross receipts rebound in a later quarter to 80% or more of the corresponding 2019 quarter. If that happens, then you cease to be a qualifying employer in the next following quarter. So let's assume you had a 60% receipts decline in the second quarter of 2020. That makes you an eligible employer. But assume your business rebounds and you only have a 10% receipts decline in the third quarter. Because of the way this rule is drafted, you would generally still be eligible to claim the credit for quarters 2 and 3, but you would not meet the gross receipts test for the fourth quarter unless your business qualified for the fourth quarter with a 50% decline in that quarter. The rules are different for 2021, and fortunately a little bit simpler. It's in determining eligibility for the first 2 quarters of 2021, you only have to show a greater than 20% gross receipts decline to be eligible for that quarter. And each 2021 quarter is determined independently. Also in 2021, that complex receipts rebound limitation I just described no longer applies. The gross receipts test is determined based entirely on each quarter's comparative gross receipts independently. In doing the gross receipts decline calculation, you are still allowed to compare each 2021 quarter with the corresponding gross receipts of the business in the corresponding pre-pandemic quarter in 2019. So, for example, you can compare Q1 2021 to Q1 2019 to meet the test for Q1 2021. So that's the general rule, but there's now a second way to calculate the gross receipts test for quarters in 2021 that may be advantageous. If you want, you can look at the preceding quarter to see if you qualify for the current quarter in 2021. So for example, in determining your first quarter 2021 eligibility, you could compare your fourth quarter 2020 gross receipts with your fourth quarter 2019 gross receipts. That alternative rule is important because it may allow a business to claim the ERTC earlier. So if you know your receipts were down more than 20% in Q4 2020 when compared to Q4 2019, you already know that you are an eligible employer for purposes of the ERTC in Q1 of 2021. Not only do you not have to wait to see what happens to your receipts in Q1 of 2021, but you are still eligible for Q1 even if your business bounces back and you don't ultimately have a 20% receipts decline in Q1 2021. So once you are an eligible employer, you have to determine which of the wages you paid are qualified. As we already discussed, there's an overall employee by employee cap on qualified wages. But let's turn to what wages you can count. In short, wages are generally only qualified if they are wages subject to Social Security tax. So an employee's 401k contributions count because they are not subject to Social Security tax. But employer contributions to 401ks, including matches, do not count because they are not subject to Social Security tax. There's one big exception to this general Social Security tax rule. Group health plan expenses, including employer and employee pre-tax premiums, can be qualified wages even though they are excluded from Social Security wages. Although there is no direct guidance, it appears that pre-tax contributions to health FSAs are included as qualified wages. The self-employed can claim the ERTC on wages and group health plan expenses paid to employees, but they cannot with respect to self-employment income that is subject to SECA, but not FICA. So that is the general definition, but not surprisingly, you're not allowed to count qualified wages paid during the period the employer is not an eligible employer. The general rule is that qualified wages are only those wages paid with respect to the period the business is suspended by government order or in the quarter in which the employer satisfies the reduction in receipts test. That basic rule is pretty simple, but after that, there are different rules for small and large employers. The general rule for larger employers is that qualified wages are the wages paid to employees who are not performing services during the period of the government ordered shutdown or during the quarter when the reduction in gross receipts standard is met. So for larger employers, you only get the credit for wages you pay employees not to work. But there is a much more generous rule for small employers. That rule allows the eligible employer to count all wages paid during the shutdown or the entire qualifying quarter of gross receipts decline, even if the employee is still working, still performing services. For 2020, that special small employer rule is only available to employers with 100 or fewer employees. Now for 2021, the generous special rule is available to employers with 500 or fewer employees. For both 2020 and 2021, the number of full-time employees is based on the average number of full-time employees during 2019. If it's a close call, you'll want to consult your tax advisor on how to aggregate control groups of businesses and how to determine the average number of employees in 2019, including the treatment of part-time employees. In addition, for 2021, the new law repeals a rule that prevented counting certain pay increases as qualifying wages. But in doing your calculation for 2020, you will still have to consider that pay increase limitation that is in effect for 2020. As I mentioned, until the year-end bill, you couldn't claim the ERTC if you had a PPP loan. Allowing a business to utilize both programs is probably the most important change that was made for many small businesses. And because it was done retroactively to 2020, it has left many people scrambling to try to determine if they qualify for 2020, and if so, for how much. The key here is that the new rule does not allow you to double count the same wages for PPP forgiveness and for claiming the ERTC. But it isn't always clear what it means to count wages for the PPP or which wages are counted. Also, there are other ways to qualify for PPP loan forgiveness that don't involve wages. The interaction of those and other variables make it important to coordinate your PPP forgiveness with your ERTC. The problem is that the IRS and the Small Business Administration have not yet provided guidance on how to do it. So you'll want to watch carefully for guidance on the interaction of the two programs. This is a good place to emphasize another fairly simple point. If you must count wages to justify forgiveness of a PPP loan, you are generally going to be better off allocating those wages to the PPP loan. That's because the forgiven PPP loan basically has the government paying 100% of the wages, whereas the government only pays 50% of the wages under the ERTC in 2020 or 70% in 2021. In addition, as I mentioned, wages used to support PPP loan forgiveness remain deductible to the employer, whereas the deduction for wages used to claim ERTC would be reduced by the amount of the credit. So I think almost everyone will want to get their maximum PPP loan forgiven first and then claim as much ERTC as possible after that. But to the extent that the employer can get its entire PPP loan forgiven anyway, by relying on items other than wages, things like rent, mortgage, and other expenses that are allowed, that will open up additional wages for the ERTC. That process, though, is complicated by the fact that to maximize PPP loan forgiveness, you must have a certain percentage of the cost used to justify forgiveness coming from wages you paid. The bottom line is that for small businesses, the PPP and the ERTC are intertwined, and deciding where you use qualified wages could affect how much you benefit overall. Before you make final decisions, you will want to take those interactions into account. In addition, it's worth noting the CAA also expanded the rules that prevent double counting the same wages for various federal tax credits, like the Work Opportunity Tax Credit and the COVID-related paid leave credit, among others. The interactions between those various credits, starting in Q1 2021, but also on some of them retroactive to 2020, will also need to be watched if you're utilizing them, and we will hopefully get some additional IRS guidance on how those calculations are performed. So let's turn to how you claim the credit. As I mentioned, the ERTC is a refundable credit against payroll tax obligations of the business claiming the credit. Generally, these payroll taxes are paid in connection with each payroll disbursement and are reported on a quarterly Form 941 that the business or its PEO must file. The ERTC, like other credits against payroll tax, is structured to expedite the benefit of the credit by allowing the business to access the credit through reductions in its payroll tax payment obligations in the amount of the credit that the business is entitled to receive. It is important to work with your PEO in claiming the ERTC through this mechanism. Because the ERTC is refundable, the business is still entitled to the credit even if the credit exceeds the amount of the payroll taxes the employer owes. The IRS has set up a mechanism for businesses to access excess credits against payroll tax in advance. If you are eligible, it is done through the Form 7200. The Form 7200 is only available for advance payments, not for refunds. IRS rules require businesses to give a copy of any Form 7200 they file to their PEO. A failure to do so is likely to result in problems with the IRS and could delay processing of the ERTC. In addition, the CAA placed limits on the advance payment of excess credits claimed on the Form 7200. So starting in 2021, those advance payments will only be available to employers with 500 or fewer employees and will be capped at 70% of the average 2019 quarterly wages of those employers. So let me sum up the main points I made today. First, if your business qualifies, claiming the ERTC could result in getting sizable payments from the federal government to help keep your business running. Your PEO or other payroll tax processor will assist you with ERTC, but the responsibility for determining your eligibility and the amount of your ERTC that you are entitled to claim from the IRS is ultimately yours. If you have not already made ERTC claims based on 2020 eligibility, you will want to determine eligibility and qualified wages for purposes of making a retroactive claim. The IRS has not yet finalized guidance on how to proceed to claim the retroactive ERTC, but you will want to work with your PEO on those issues once the process is clear. For 2021, it may already be possible to begin claiming the credit against payroll taxes if you can demonstrate you are an eligible employer. For example, if you had a 20% decline in gross receipts for Q4 2020 compared to Q4 2019, or a suspension of the business by government order in 2021, then at least some of your Q1 2021 wages will probably qualify for the ERTC. If that is the case, the existing IRS processes for claiming the ERTC are still available. Once you've determined the amount of ERTC you are eligible to claim, you will need to work closely with your PEO to expedite receipt of your ERTC payments. But keep in mind that the IRS has not yet published definitive guidance on some of the aspects of claiming the ERTC, so getting the money you are due may be delayed in some cases. We've covered a lot today. I warned you it would be complex. So my final takeaway is that if you have any further questions, your PEO is a great place to start looking for the answers.